There is a moment in every trader's journey where the market stops feeling like numbers and starts feeling like a mirror reflecting our fears, our expectations, our impatience, and the stories we quietly tell ourselves about who we are and who we might become. Trading isn't just charts and strategies. It's psychology. It's self-awareness. It's the ability to stay grounded when everything inside you wants to react. And nowhere is that psychological test more intense than during earnings season. This episode is not about predicting the next big move. It's not about finding a magic strategy. It's about understanding the invisible force that determines every win and every loss your mind. So take a breath, slow down, and allow yourself to enter this space with clarity, curiosity, and honesty. Because once you understand the psychology behind IV Crush and the emotions that drive your decisions, you won't just trade differently. You'll think differently. You'll see differently. You'll become a different trader entirely. Welcome to Mind Over Markets. Let's begin. You're about to enter a different kind of trading video. Not a strategy, not a setup, not another promise of quick gains. This is a journey inward, a look into the hidden part of trading, the part that decides your wins, your losses, your reactions, your future. If you trade NQ futures, you already know the battlefield isn't the chart, it's your mind, your emotions, your impulses, your patterns. This video is for the trader who's tired of repeating the same mistakes, the trader who's tired of blowing up after doing everything right, the trader who knows their biggest enemy is the version of themselves they become under pressure. Here, we're not just trying to trade better. We're trying to think better, to feel better, to respond better. Welcome to Mind Over Markets. Let's begin. There's a moment every trader knows, a moment when the chart stops being a chart and becomes something else, a threat, a judgment, a voice that whispers, you're losing, you're behind, you're not enough. For most people, the market is just numbers. But for a trader, especially a trader in NQ futures, those numbers feel personal. And if you've traded NQ long enough, you've felt it. That sudden emotional shift, that internal snap, that mental drift from calm to chaos, from composed to tilted. This video is about that shift. It's about why it happens, how it destroys you, and how you can climb out of it, returning to a place where every decision is clean, neutral, fearless, flat. But to understand the climb, we have to understand the fall. Let's begin. Tilt doesn't announce itself. It doesn't warn you. It doesn't say, hey, I'm coming, prepare yourself. No. Tilt arrives quietly like a fog. Then suddenly, you can't see anymore. You can't think anymore. You only react, you only chase, you only want to fix the pain. Tilt is not just anger, not just frustration. Tilt is a full psychological breakdown of decision-making. It's when your mind stops operating like a trader and starts operating like a wounded animal. And NQ, more than almost any market, triggers this state with precision. Why? Because the NASDAQ is a psychological amplifier. It moves fast, it moves violently. It gives gains in seconds and takes them back in less time. It punishes hesitation, tempts aggression, and seduces you with the illusion that just one more trade might fix everything. That's the trap. And let me tell you something you might not want to hear. NQ doesn't tilt you. Your relationship with uncertainty tilts you. Your hidden expectations tilt you. Your ego, your fear, your unresolved beliefs about money. That's what tilts you. The market only exposes what was already inside you. Now let's peel back the layers. Tilt begins long before the moment you notice it. It begins with tiny disappointments, small losses that feel unfair, missed entries that sting more than they should, a setup that almost works, but doesn't. And each time your mind records a tiny emotional debt, a tiny imbalance. Then suddenly one trade pushes you over the edge. It's rarely the biggest loss. Often it's the one that was supposed to be right, the one you were sure about, the one you believed in. And when that trade fails, your brain interprets it not as statistical variance, but as betrayal. That's when the emotional brain, the amygdala, takes over, and the rational brain, the prefrontal cortex, shuts down. You stop analyzing probability. You stop evaluating risk. You stop recognizing your own strategy. Your entire focus narrows down to one single objective: get it back. In that moment, you are no longer trading the market. You are trading your emotions. You are trading your pain. This is tilt. But what's fascinating is how differently traders try to escape it. Some fight, some freeze, some double their size and pray. Others keep clicking, unable to stop. But all tilted traders share one thing: they lose the ability to see clearly. They lose neutrality. And neutrality is everything. To understand the opposite of tilt, we need to understand the state called flat. Flat is not simply having no position. Flat is a psychological condition, a clean mental baseline, a place where emotion has no weight, where past trades have no influence, where the market isn't a threat, and every decision is fresh. Flat is the state where the best trading happens. It's calm, it's focused, it's deliberate, it's free of emotional residue. Flat is what traders want. Tilt is what traders fear. And the journey between these two states determines your long-term survival in NQ futures. So let's go deeper. Why is NQ so effective at pulling traders out of flat and into tilt? Because NQ weaponizes uncertainty. Its volatility is not random. It's structural. It's born from liquidity pockets, algorithmic speed order flow imbalances, and the psychological behavior of millions of traders acting at the same time. When NQ snaps 20 points against you in 1 second, your nervous system experiences a microshock. Your cortisol spikes, your breath shortens, your vision narrows, your logical processing collapses. When NQ whips you out of a trade only to immediately run in your direction, without you, you experience a form of psychological rejection. When you miss a perfect entry by half a tick, your dopamine system generates a frustration response. These microshocks add up. They build tension inside your mind, and eventually they break you. That's why NQ is a dangerous teacher, but it's also a revealing one. It shows you who you really are under pressure. Because here's the truth: you don't rise to the level of your best self during a volatile market. You fall to the level of your emotional patterns. NQ exposes those patterns brutally. Tilt is not a market problem. Tilt is a brain state problem. Your brain evolved to keep you alive, not to help you win in a probabilistic environment. And when the brain senses threat, financial loss, uncertainty, unpredictability, it does what it has done for millions of years. It reacts instinctively. That reaction is incompatible with trading. To trade well, you must operate from System 2, the slow, analytical, rational part of the mind. But tilt forces you into System 1, fast, emotional, reactionary. This shift is not subtle. It is neurological. When a trader is tilted, the amygdala floods the system with emotional energy. The prefrontal cortex loses computational power. The trader stops calculating probability and starts acting out of impulse. Impulse is the enemy of consistency, and consistency is the foundation of profitability. So how do we return from tilt to flat? How does a trader reset the mind when everything inside feels charged, chaotic, unstable? It starts with one radical idea. You must stop trading the moment you lose yourself. Not when the account is down, not when the strategy breaks, not when you are angry. The moment you feel the shift, the instant your breathing changes, the instant you notice your decisions tightening, that is the moment to stop. Cut the trade. Step away. Because staying in the market while tilted is like driving drunk. It's not just risky, it's delusional. The problem is when you're tilted, you don't feel drunk. You feel determined. But that determination is not strength. It's emotional distortion. So the first step back to flat is the simplest and yet the hardest stop. Stop immediately. Stop regardless of how close you think you are to recovering. Stop despite every part of you screaming not to. That moment of stopping is the beginning of clarity. Then you step away from the screen. Not for a minute, not for 30 seconds. Long enough for your nervous system to come down. Long enough for your breathing to normalize. Long enough for your mind to detach from the emotional residue of the previous trade. You let the storm pass. Because tilt is a physiological storm, and storms don't disappear through willpower. They end through time. Once the storm softens, you breathe slowly, deeply. In for 4, hold for 6, out for 8. Not because it's spiritual, because it physically shifts your nervous system back into parasympathetic calm. It gives your rational mind a chance to come back online. Now with space between you and the emotion, you reset the narrative. You remind yourself, the past trade is gone. The next trade is independent. I do not need to make money back. I only need to execute my plan. This mental reset is how you begin returning to flat. Flat is neutrality. Neutrality is power. When you're flat, your mind is not pulling you forward or backward, not into fear, not into aggression. It's steady. You don't anticipate your next trade. You simply observe. You don't try to force the market to pay you. You wait for the market to offer you an opportunity. In flat, you think clearly. You manage risk precisely. You allow randomness to unfold without interpreting every tick as a personal message. Flat is the psychological home base of a trader. It's where the best decisions are born. But staying flat requires discipline, because NQ is relentless. It tests your patience, your beliefs, your self-control, your attachment to outcomes. If your identity is tied to winning, NQ will break you. If your ego is tied to being right, NQ will crush you. If your emotions define your actions, NQ will expose you. To stay flat, you must release outcome attachment. You must trust your risk parameters. You must honor your strategy more than you honor your impulses. You must learn to sit through boredom, uncertainty, and temptation without breaking. And you must accept that neutrality is not natural. It is trained. There is a moment every trader must face, not during a win, not during a smooth session, but during the moment of maximum internal conflict, the moment when tilt whispers, "Come on, just one more trade. You can fix this. You can get it back." That whisper destroys traders. But if you can hear it and say no and step away, you unlock something powerful. You unlock emotional mastery. And emotional mastery is more valuable than any technical pattern, any indicator, any strategy. Trading NQ futures is not a test of intelligence. It is a test of emotional resilience, a test of patience, a test of how well you can regulate your internal world while facing an external world that is unpredictable, chaotic, and unforgiving. Success in NQ does not belong to the smartest trader. It belongs to the calmest trader, the trader who sees clearly, thinks cleanly, acts with intention, not emotion. The trader who can move from tilt back to flat again and again, no matter how many times the market tries to pull them off balance. This is the skill. This is the difference. This is the path. And if you can master that shift from tilt to flat, you will survive, you will grow, you will trade like someone the market cannot manipulate, because the market can only control you through your emotions. Once you master your emotions, you master the game. This is the psychology of NQ futures. This is the journey from chaos to clarity, from tilt to flat. And this journey is the difference between blowing up and becoming unstoppable. If you made it to the end of this video, you're not just a trader. You're someone who wants clarity, control, consistency. You're someone who understands that strategy alone is not enough. Mindset is the real edge. The market will always be volatile. It will always surprise you. It will always tempt you. But your reactions, your breath, your discipline, your neutrality, that's the part you control. That is where your power lives. Every time you fall into tilt, you also have the chance to rise out of it, to return to flat, to return to clarity, to return to the version of yourself that sees the market with calm eyes and an unshakable mind. If this message resonated with you, you're in the right place. This channel exists for one purpose: to help traders think deeper, feel stronger, and trade from a place of mastery, not emotion. Thank you for watching. Take a breath, stay disciplined, stay neutral, and always remember, your greatest trade will always be the one you make inside your own mind. Welcome to Mind Over Markets. I'll see you in the next video. Every trader remembers their first big earnings trade, the adrenaline, the certainty, the belief that this time the market will finally reward them. And if you've traded options long enough, you also remember the heartbreak, the disbelief of watching a stock move exactly in the direction you predicted. Yet the option you bought collapses like sand slipping through your fingers. You stare at the screen confused, angry, frustrated. How did I predict the earnings move and still lose money? And then comes the realization: implied volatility. IV crush. The invisible force that punishes traders who don't understand the psychology beneath the chart. But the real reason so many traders struggle with earnings has nothing to do with Greeks or deltas or gamma. It's the mind. It's the way your psychology reacts to uncertainty, risk, and the illusion of opportunity. Earnings is not just a financial event. It's a psychological storm. And today we're going to walk straight into the center of that storm, not to fear it, but to understand it, to master it, to stop being a victim of IV crush, and instead become a trader who sees earnings for what they truly are, a mirror reflecting the deepest fears and desires inside you. Because until you master the psychology of earnings, you will always lose to the traders who have. Let's begin. Every earnings season, tens of thousands of traders open their platforms with the same thought. This is the one. This is the trade that will change everything. They scroll through the charts. They study recent price action. They analyze what happened last quarter. And slowly, they build confidence. Confidence that feels like skill. Confidence that feels like certainty. But certainty is the first illusion, and it's the most dangerous one, because earnings is not about knowing, it's about not knowing, and how you behave when you don't know. Most traders don't trade earnings. They trade the emotional high that comes from placing a bet on the unknown. They trade the thrill. They trade the excitement. They trade the fantasy of waking up wealthier tomorrow morning, and the market knows that. It prices that excitement into implied volatility. Every week leading up to earnings, V rises, not because the stock is riskier, but because the traders are more emotional. IV is not a measure of danger. IV is a measure of anxiety, a measure of anticipation, a measure of how desperate people are to be right. And when earnings finally arrive, that anxiety disappears in an instant. And the price of that anxiety, the inflated premium you paid, disappears with it. That's what crushes you, not the market, not the stock move, but your own emotions, priced into the contract you just bought. Most traders understand IV crush intellectually, but they don't understand it emotionally. They don't see that IV crush is actually a psychological crush, a collapse of hope, a collapse of illusion, a collapse of the inner belief that they can predict the unpredictable. That's why the pain feels so sharp, because it's not just money you lose, it's certainty, it's identity, it's the image you had of yourself as a trader who knew what was coming. And that brings us to the heart of the problem. Earnings don't destroy traders, their expectations do. Before earnings, your mind paints a future, a version of the world where the stock explodes in your direction, where your options multiply, where everything finally makes sense. And when that future collapses after earnings, your brain fights back. It refuses to accept the loss. It refuses to accept the randomness. It refuses to accept the fact that you never had control in the first place. This is where anger begins. This is where revenge trading begins. This is where the psychology of earnings becomes toxic. And if you don't understand this pattern, you will repeat it every single quarter for years. Let me tell you a story. There was a trader, let's call him Michael. Michael spent weeks preparing for a single earnings play. He researched the company. He analyzed the fundamentals. He went through every earnings reaction for the past 5 years. He had a thesis, a clear conviction. The company had been beating expectations quarter after quarter. The stock had strong momentum. Analysts were optimistic. The setup looked perfect. Michael bought calls, expensive calls, calls inflated by soaring implied volatility. When earnings came out, the company beat expectations again. The stock opened higher. Michael smiled. Everything happened exactly as he predicted. But then he looked at his options. Red, deep red, down 60%. How could he be right and still lose? He refreshed the screen, convinced there must be a glitch. There wasn't. That was the moment Michael learned what every trader eventually learns. Predicting direction doesn't protect you from premium decay, and knowledge doesn't protect you from emotions. He felt betrayed, cheated, not by the market, but by his own expectations. And that betrayal turned into anger. Anger turned into revenge. And revenge turned into a series of impulsive trades, each one worse than the last. This is the psychological pattern of almost every trader who struggles with earnings: excitement, hope, certainty, shock, confusion, anger, revenge, regret. The cycle repeats because the trader does not understand the real threat. The real threat is not the stock reaction. It's the emotions before the reaction. Earnings amplifies every psychological weakness you have. Your need to be right, your need for excitement, your desire for quick wins, your fantasy of catching the big one. It's not the event that tests you. It's your relationship to uncertainty. And that's what implied volatility truly measures. Not math, not risk, but fear, human fear. Now think about this. If implied volatility is a price on fear, then buying options before earnings means buying other people's fear at the highest possible price. And after earnings, when the fear disappears, that price collapses. This is the emotional dynamic behind IV crush. You're paying for a feeling, not a probability. A feeling that dissolves the moment earnings are released. And the mistake most traders make is believing they are paying for direction. But in reality, they're paying for psychology. Understanding this is the beginning of mastery, because earnings is not just a financial battlefield. It's a psychological battlefield, and the traders who survive are not the ones who predict correctly, but the ones who manage their mind correctly. And this brings us to a deeper truth. Most traders don't actually want to trade earnings. They want to feel alive. They want the thrill, the anticipation, the idea that something dramatic might happen. that maybe this time they'll catch the move that changes everything. But that desire comes at a cost because the market charges a premium for excitement. And that premium is IV. The more emotional the crowd becomes, the more expensive the trade becomes. Not because the stock deserves it, but because the traders do. Earnings is one of the purest tests of emotional discipline in the market. It exposes your biases, your illusions, your gambling tendencies, your need for instant gratification. It shows you who you really are. And if you want to survive earnings season, or better yet, thrive in it, you must begin by understanding the psychology that drives you toward these trades. So let's break down the 4 emotional traps that pull traders into terrible earnings decisions. The first trap is FOMO volatility. It's when you see IV rising and interpret it as opportunity. You think the market expects a big move. I want to catch that move. But that's not what rising IV means. It means the market expects uncertainty, not direction. The second trap is the illusion of accuracy. You convince yourself that if you analyze hard enough, you can predict the direction of the earnings reaction. But earnings reactions are not about fundamentals. They're about expectations. And expectations are psychological. The third trap is the jackpot fallacy. You remember the one time you hit a big earnings trade, and your mind exaggerates that memory. It tells you you can do it again, even though the probability was never in your favor. And the fourth trap is revenge trading. The moment you lose to IV crush, your brain goes into emotional defense. It wants to win back the loss. It wants redemption. It wants to prove that you were right all along. But revenge trading during earnings season is like trying to put out a fire with gasoline. You don't fix the damage, you multiply it. These 4 traps are the psychological engine that drives bad earnings decisions. And if you don't understand them, you will continue to trade earnings emotionally, not logically. Now here's the most important realization: earnings plays are not inherently bad. IV crush is not the enemy. The enemy is the way you think about earnings. Most traders approach earnings like a lottery ticket, but professionals approach it like a probability puzzle, a volatility game, a psychological experiment. Professionals don't chase direction. They study expectations. They don't get seduced by high IV. They exploit it. They don't create stories about the outcome. They analyze the cost of uncertainty. The difference is mindset, not intelligence, not tools, not strategy, mindset. If you can change that mindset, you can change the way you trade earnings forever. And in the next part of this script, we're going to dive deeper into the psychological strategies that allow you to trade earnings without fear, without illusions, and without falling victim to IV crush. But first, take a moment to reflect on this: how much of your earnings trading is driven by logic, and how much is driven by emotion? Be honest, because the market already knows the answer. Most traders don't realize this, but the real challenge of earnings season doesn't come from the chart in front of them. It comes from the internal chart inside their mind, the chart they never see, but the one that controls every decision they make. It is the chart of emotion, of fear, of anticipation, of longing, of impatience, of the deep inner belief that maybe, just maybe, this one trade will save them. Until you understand that chart earnings will always feel like chaos, like randomness, like a personal attack. But once you understand the psychological patterns behind your decisions, earnings stop being emotional and start becoming predictable, not in the sense of direction, but in the sense of how your mind reacts to uncertainty. And that is where true mastery begins. Let's go deeper. When traders think about earnings, they often imagine the moment after the report, the candle, the gap up, the gap down, the explosion, the collapse. But the real psychological battle doesn't happen after earnings. It happens before. In the days leading up to the event, your mind starts constructing a narrative, a story about what will happen, a story about why this time is different, a story about why you need to take this trade. You don't just analyze the company, you analyze yourself. You analyze your past. You analyze your hopes for the future. Earnings becomes more than a trade. It becomes symbolic. It becomes the answer to every frustration you've had with the market. It becomes the solution to the losses you want to recover. It becomes the validation you desperately seek. And the moment a trade becomes symbolic, you've already lost the psychological battle. Because symbolic trades are emotional trades. And emotional trades are expensive, more expensive than any IV. This is why rising implied volatility feels irresistible. It aligns perfectly with your emotional expectations. IV is not just a number. It's a reflection of collective tension. It is the mathematical imprint of fear, greed, and desperation. When you see IV rising, you don't just see uncertainty. You feel possibility. You feel the pull of potential. You feel the market whispering to you, something big is coming. But that whisper is not an opportunity. It's a trap woven from psychology, not data. Let's take a moment to talk about why the human brain is so vulnerable to this. Humans are wired to overestimate the probability of dramatic events. It's why lotteries work. It's why casinos thrive. It's why news headlines are sensational. Our brains are drawn to extremes, to things that feel explosive, to outcomes that could change everything with one decision. Earnings feeds that bias perfectly. It packages uncertainty into a single date, a single hour, a single candle. In that moment, it doesn't feel like a trade. It feels like destiny. But professionals know something that most traders don't. Destiny has no place in trading. Only probabilities do. This is why so many retail traders get destroyed during earnings. They think their analysis is the truth, but their analysis is just a story their mind created to feel safe in a moment of uncertainty. The market does not trade stories. It trades expectations, and expectations are psychological. Every earnings season, you are not competing against the stocks. You are competing against the collective expectations of millions of minds. Minds that are fearful, hopeful, anxious, unpredictable. To survive this battlefield, you must stop trading the story you believe and start trading the psychology that actually moves the market. Let's break it down clearly. When implied volatility rises, it does not mean the stock will make a big move. It means the market is uncertain. It means a large number of participants are anxious. It means there is disagreement, fear, and tension. You are not paying for the move itself. You are paying for the emotional anxiety baked into the option price. And after earnings, that anxiety disappears instantly. The moment the report is released, uncertainty collapses, and the price of that uncertainty collapses with it. This is IV crush. It is not a mathematical phenomenon. It is a psychological phenomenon, a collapse of fear, a collapse of tension, a collapse of all the emotional energy that was priced into the contract. You are not trading math. You are trading the emotional behavior of crowds. And the crowd is almost always wrong. But inside this chaos, there is a very simple truth. If you want to survive earnings, you must stop trying to predict the outcome and start understanding the psychology driving the pricing. Because the psychology is what determines the win or loss far more than the actual earnings result. Let's explore the psychological traps one by one in a deeper way than we touched on before. The first trap is the big move fantasy. You imagine a massive gap. You imagine waking up to a huge profit. You imagine the reaction being dramatic. Your mind craves intensity. It craves events that feel life-changing. And earnings is the perfect stage for that fantasy. But fantasies cloud judgment. They silence logic. They drown out risk management. You stop asking reasonable questions like, what is the implied move? How much does the market already expect? Is the premium justified? Instead, you ask emotional questions. What if this is the one? What if I miss out? The second trap is the illusion of control. This is when you believe your research gives you an edge in predicting the reaction. But even analysts with decades of experience fail to predict earnings reactions consistently. The market reacts not to earnings results, but to the distance between reality and expectation, between what happened and what the market imagined would happen. It's not about the numbers, it's about the psychology of surprise. Most traders don't understand this, so they rely on logic in a situation where logic has no power, and they pay the price. The third trap is memory distortion. Your mind remembers the one time you hit a massive earnings trade, and it replays that memory over and over. It amplifies it. It glorifies it. It convinces you that it will happen again, but it forgets the losses. It forgets the IV crush. It forgets the trades that went nowhere. Your brain selectively remembers peak emotional moments because they felt intense, and intensity feels meaningful. This is not analysis. This is nostalgia, and nostalgia is dangerous in trading. The fourth trap is identity conflict. This is when you attach your self-worth to being right. When you treat trading as a reflection of your intelligence, your skill, your identity. So when you lose on an earnings trade, you don't just lose money. You lose confidence, you lose pride, you lose a piece of who you think you are. And when identity is threatened, the brain does something very predictable. It fights back, it doubles down, it enters revenge mode. It tries to restore the lost piece of pride. This is why revenge trading is so common after earnings losses. The brain isn't trying to make money. It's trying to repair identity. But trading is not identity. It is probability. The moment you trade to protect your identity, you have already stepped into the psychological trap that earnings was designed to expose. So how do you break out of this cycle? How do you approach earnings without falling into the same emotional patterns that have hurt so many traders before you? You begin by shifting your mindset. Earnings is not a prediction game. It is a risk game, a volatility game, a psychology game. You cannot control the outcome, but you can control your approach. The first step is reframing your relationship with uncertainty. Instead of fearing uncertainty or trying to eliminate it, you accept it. Professional traders embrace uncertainty because they understand it cannot be removed, only priced. When IV is high, it means uncertainty is expensive. And you must ask yourself a simple question. Is it worth paying for emotional tension? Is the premium justified? Is the expected move realistic? Most of the time, the answer is no. The second step is separating direction from volatility. This is where most traders fail. They think earnings is a directional event, but options pricing treats earnings as a volatility event. You must decide which game you are actually playing. If you are betting on direction, you must accept that IV will fight against you unless the move is dramatic. If you are betting on volatility, you must understand that you are betting against the psychology of the crowd, not the fundamentals of the company. Clarity is psychological power. Confusion is psychological weakness. The third step is size. Small size is not cowardice. It is discipline. It is clarity. It is what keeps your emotional system calm enough to think clearly during extreme uncertainty. When your size is small, your mind stays logical. When your size is large, your mind becomes emotional. Size determines psychology. Psychology determines outcomes. The fourth step is removing hope from the equation. Hope is the enemy of rational thinking. Hope blinds you to probabilities. Hope makes you ignore IV. Hope makes you believe outcomes that feel good instead of outcomes that are likely. Trading is not about what feels good, it is about what is true. And truth is found in numbers, not emotions. The fifth step is journaling. Journaling exposes your real motivation. It forces you to confront the emotional reasons behind your decisions. It reveals whether you are trading a plan or trading a feeling. Every trader should answer 2 questions before taking an earnings trade. Why am I taking this trade? And would I still take it if the premium were doubled? If the answer changes, you are not trading a setup. You are trading emotion. And the final step is humility. Humility acknowledges that earnings is not a place to be a hero. It is not a place to prove yourself. It is not a place to chase validation. Humility keeps you safe. Pride gets you crushed sometimes, literally. When you adopt these principles, earnings stop being emotional landmines. They become structured events you can approach logically, calmly, with clarity instead of desperation. You begin to see what other traders don't see. You see the emotional pricing, you see the crowd psychology, you see the behavioral patterns, and slowly you stop being the trader who gets destroyed by IV crush and start becoming the trader who exploits it. But we're not done. In the next part of this script, we will dive into the tactical psychological strategies used by professionals to navigate earnings with mastery. How to evaluate expected move psychologically. How to approach uncertainty without fear. How to time entries to avoid emotional pricing. How to choose strategies based on your emotional profile. How to detach from the outcome and focus on the process. Because the deeper you understand the psychology, the easier earnings becomes. And the more clearly you see the truth, the more opportunities begin to appear where others only see chaos. If you've come this far, then you already understand something most traders never learn. Earnings is not a battle against the market. It is a battle against the mind, against impulsiveness, against hope, against the deep-rooted need to be right. And once you see earnings through this psychological lens, something strange begins to happen. The chaos starts to make sense. The volatility becomes less intimidating. The reactions seem less random. You realize you are not trying to outsmart the stock. You are trying to understand the emotional expectations of the crowd. You are trying to navigate the shifting landscape of fear and anticipation. You are trying to trade human psychology disguised as numbers. To do that, you need a framework not for predicting earnings outcomes, but for managing yourself inside the emotional storm. This is where professionals separate from amateurs. Professionals do not enter earnings because they believe they know the outcome. They enter only when they understand the psychology behind the pricing. They don't trade the event. They trade the expectation. They trade the crowd. They trade the behavioral patterns that repeat every single quarter. So let's go deeper into the psychological strategies that can transform the way you navigate earnings, not with fear, not with hope, but with clarity. The first psychological strategy is what I call expectation detachment. Expectation detachment means removing the desire for a specific outcome. It means entering a trade with no emotional attachment to whether the stock gaps up or gaps down. It means accepting the reality that the outcome is uncontrollable. When you detach from the expectation, your mind shifts from prediction to probability, from emotion to structure. This is the mindset shift that allows you to analyze objectively. It frees you from the invisible pressure to be right. It releases you from the anxiety that clouds your judgment. Expectation detachment turns earnings from a gamble into a measured decision. It turns noise into opportunity. It turns uncertainty into clarity. But most traders can't do this. Their expectations are too heavy. They desperately need the trade to work. And that desperation distorts everything: the analysis, the sizing, the timing. A mind that needs a result cannot think clearly. It can only react. The second psychological strategy is probability humility. Probability humility is the acceptance that you can never know what earnings will bring. It is the recognition that even the most perfect analysis can fail, because the market does not react to numbers. It reacts to expectations. Humility protects you from overconfidence. It keeps your size appropriate. It prevents you from treating earnings as a certainty. Traders who lack humility take oversized bets. They chase jackpots. They expose themselves not just to IV crush, but to emotional crush. The collapse of confidence, the collapse of discipline, the collapse of reason. Humility is not weakness. In trading, humility is armor. It shields your mind from delusion. It creates space for rational thought. It prevents emotional hijacking. The third psychological strategy is clarity of purpose. Before entering an earnings trade, you must know exactly what game you are playing. Are you playing a volatility game, a direction game, a probability game, a purely emotional game? Most traders don't know. They enter earnings because they feel something: curiosity, excitement, hope, fear of missing out. But trading should never be driven by feelings. It should be driven by purpose. Clarity of purpose means you can answer the question, what exactly am I trying to extract from this trade? If you cannot answer that question clearly, you are not trading. You are gambling with psychological justification. The fourth strategy is emotional pre-acceptance. This is one of the most powerful mental tools in earnings trading. Emotional pre-acceptance means fully accepting the loss before the trade even begins. Not in theory, not intellectually, but emotionally. You must be able to say, if this trade goes to zero, I am okay with that. Not because you want it to happen, but because you are mentally prepared for it. When you accept the loss beforehand, you neutralize the emotional impact of the outcome. You prevent panic. You prevent regret. You prevent revenge trading. Pre-acceptance transforms your mental state. Instead of trading from fear, you trade from stability. Instead of reacting emotionally, you respond logically. This is how professionals stay calm during earnings, not because they know the result, but because they have already accepted every possible outcome. The fifth strategy is context awareness. Earnings does not happen in a vacuum. It happens within context, within the market environment, the sentiment, the sector trend, the volatility structure. A stock with high IV in a calm market behaves differently from a stock with high IV in a fearful market. A stock with rising implied move behaves differently from a stock with flat implied move. A stock with strong momentum behaves differently from a stock in distribution. When you ignore context, you amplify unpredictability. But when you understand context, you anchor your decisions in reality. Context is psychological grounding. It prevents you from being swept away by excitement. It forces you to think clearly. The sixth strategy is structural awareness. Structural awareness means understanding how the option chain reflects crowd psychology, the skew, the expected move, the pricing of wings, the behavior of near-the-money contracts, the imbalance of open interest, the unusual pricing of time decay. These are not numbers, They are emotional fingerprints, the visible imprint of collective belief. When the expected move is unusually high, it means the crowd is fearful. When skew is distorted, it means the crowd is leaning emotionally in one direction. When strangles are overpriced, it means the crowd expects chaos. Trading without structural awareness is like trying to read a book without understanding the language. The seventh strategy is option selection discipline. Every decision you make in an earnings trade reveals your psychological state. Buyers reveal hope. Sellers reveal confidence. Spreads reveal caution. Complex structures reveal strategic thinking. You must choose the structure that aligns with your emotional needs, not your fantasies. If you cannot handle being wrong, you should not buy naked calls. If you cannot handle volatility collapse, you should not buy premium at all. If you crave certainty, you should not trade earnings. If you crave excitement, you should avoid it even more. Your choice of option structure reveals the truth about your mindset, even the truth you hide from yourself. The eighth strategy is entry timing discipline. Most retail traders enter earnings trades emotionally early. They buy premium when IV is still rising, when excitement is at its highest, when crowd psychology inflates prices. Professionals wait. They enter when IV stabilizes. They enter when emotional pricing is complete. They enter when the market has fully digested the uncertainty. Timing is not about predicting direction. It is about navigating emotional waves. A badly timed trade can be right and still lose. A well-timed trade can be wrong and still survive. Timing is psychological alignment. The ninth strategy is outcome detachment. Outcome detachment is different from expectation detachment. Expectation detachment happens before the trade. Outcome detachment happens after. Outcome detachment means refusing to assign personal meaning to the result. It means refusing to judge your worth based on the trade. It means refusing to let a win inflate your ego or a loss crush your confidence. When you detach from outcome, you prevent emotional spirals. You prevent revenge trading. You prevent cognitive distortion. Detachment is psychological freedom. It allows you to focus on process rather than result. It keeps your mind clean, clear, and capable. And finally, the 10th strategy is post-trade reflection. Most traders skip this. They take the win or the loss and move on, but that means they learn nothing. They repeat the same mistakes. They fall into the same traps. Reflection is where growth happens. Reflection is where patterns emerge. Reflection is where emotional bias becomes visible. When you reflect objectively, you see not just the trade, but yourself. You begin to notice the subtle emotional triggers, the urge to chase the fear of missing out, the tendency to oversize the desire for validation. Reflection transforms trading from randomness into self-discovery, into mastery, into psychological evolution. Now let's go deeper into one of the most misunderstood concepts in earnings trading, the expected move. The expected move is not merely a calculation. It is a psychological boundary, a line drawn by the market to represent the collective emotional expectation. When you look at the expected move, you are looking at the average fear of thousands of traders. You are looking at the average hope, the average uncertainty, the average tension. The expected move is the emotional consensus. If you trade earnings without understanding this consensus, you are trading blind. If the expected move is small, the crowd is calm. If the expected move is large, the crowd is tense. If it is unusually large, the crowd is fearful. If it is larger than historical reactions, the crowd is anxious. And when the crowd is anxious, premium becomes inflated. An inflated premium is dangerous because it creates a psychological illusion, the illusion of potential. When a contract is expensive, your mind equates the cost with opportunity. If it costs this much, something big must happen. If the market is pricing this high, it must be worth it. If IV is this inflated, the stock must move. But these are illusions. Illusions powered by emotion. Illusions disguised as logic. The expensive premium is not a sign of opportunity. It is a sign of fear. You are paying for fear, not probability. Understanding this changes everything. It changes the way you choose contracts, the way you size, the way you manage risk. It transforms your approach from reactive to strategic. Now let's talk about one more psychological trap, the illusion of safety. Some traders believe they can avoid IV crush by choosing safer strategies, like buying spreads or buying longer dated options or trading small. But if the motivation behind these choices is fear, the psychology is still flawed. Safety is not found in structure. Safety is found in mindset. A fearful trader using a safe strategy is still a fearful trader, and fear always finds a way to lose money. True safety comes from clarity, from detachment, from neutrality, from the willingness to accept uncertainty without resistance. When your mind is neutral, your decisions become precise. Your analysis becomes objective. Your emotions stop clouding your judgment. This is the psychological state needed to trade earnings successfully. Not excitement, not certainty, not fearlessness, neutrality. Neutrality is the trader's superpower. It allows you to see the truth beneath the noise. It allows you to evaluate opportunities without emotional distortion. It allows you to approach earnings not as a gamble, but as a structured risk event. In the next part of this script, we're going to bring these psychological principles to life through a powerful case study, a real-world example of a trader who predicted direction perfectly, but still lost because of IV crush, and how he transformed his strategy by transforming his psychology. And then we will enter the final segments, the deep core level mindset principles that allow you to handle IV crush with calmness, certainty, and emotional mastery. Because once you change the way you see earnings, you change the way you see yourself as a trader. Every trader who has been crushed by earnings remembers the moment clearly, the moment where reality does not match the story they built in their mind, the moment where the market reminds them painfully that it does not exist to validate their beliefs. But some traders take that pain and transform it into clarity, into discipline, into mastery. This is the story of one such trader, and his journey will show you exactly how transformation happens not by changing indicators, not by upgrading tools, but by confronting his own psychology. His name was Daniel. Daniel had been trading for 6 years. He wasn't a beginner. He wasn't reckless. But he had one weakness that kept showing up every earnings season. He couldn't resist the urge to call the move. For him, earnings was a prediction game, a test of intelligence, a chance to prove he understood the company better than the crowd. He studied financials. He read reports. He followed analyst calls. And because he did more research than most, he believed he deserved to win. But the market does not reward effort. It rewards alignment. Alignment with probability. Alignment with expectation. Alignment with psychology. This was the lesson Daniel had not yet learned. One quarter, he built a massive earnings position on a popular tech stock. He was convinced the company would beat revenue and raise guidance. And he was right, they did. But the stock barely moved. It ticked up and then faded. What followed was brutal. His calls dropped 75% at the open, not because the company was weak, but because IV collapsed. The expected move had already priced in the good news. The market had anticipated the optimism. There was no surprise, no shock, no fuel for price discovery. Daniel watched in disbelief. He had predicted everything correctly and still lost. It wasn't just a financial loss, it was an emotional fracture, a shattering of the belief that skill protects you from uncertainty. For weeks after he spiraled, he entered revenge trades. He over-leveraged positions. He tried to chase back the loss, not the money, but the validation. But trading is merciless to emotional spirals. Every attempt to reclaim pride only buried him deeper. He wasn't just fighting the market, he was fighting himself. One night after another losing streak, he sat alone staring at his trading journal. Page after page, the same pattern: overconfidence, oversizing, earnings gambles disguised as analysis, hope-driven decisions, revenge trades, emotional justification. It hit him all at once. He was not losing to the market. He was losing to the psychological version of himself, the version of himself that craved certainty, that needed to be right, that chased the high of dramatic outcomes, that feared missing out more than losing money. This realization was painful, but it was also liberating, because once you see the truth, you can no longer pretend it isn't there. For the first time, Daniel asked himself a simple question: why do I trade earnings in the first place? The answer came slowly, but it was honest. To feel something. Not to trade a setup, not to follow a strategy, but to feel alive. To feel the rush of uncertainty. To feel the possibility of a life-changing win. He wasn't trading earnings. He was trading emotion. That night, everything finally made sense. IV crush wasn't the enemy. The stock wasn't the enemy. The expected move wasn't the enemy. His expectations were the enemy. His emotional attachment was the enemy. His belief that effort equals reward was the enemy. When he finally understood this, something shifted inside him. A quiet clarity replaced the chaos. A steady calm replaced the desperation. This is the moment every trader eventually reaches, the moment where the ego breaks and the mind finally opens. From that day forward, Daniel rebuilt himself as a trader. Not from charts, not from new tools, but from new psychology. He adopted 5 new principles that changed everything. The first principle was neutrality over certainty. He stopped entering earnings trades with a bias. He no longer cared whether the stock went up or down. He only cared about whether the pricing made sense. Neutrality freed him. It made earnings less personal. It made decisions more objective. It removed the ego from the equation. The second principle was expectation over outcome. He stopped trying to predict direction. He focused on the expected move. He studied how the market priced fear, how IV expanded, how emotional tension inflated premium. He realized the expected move was more valuable than the earnings report, because the expected move was psychology made visible. The third principle was structure over impulse. Instead of buying naked calls or puts, he used structured trades, defined risk spreads, balanced volatility plays, positions designed not to win dramatically, but to align with the psychology of the event. He started using strategies that matched the environment, not his emotions. The fourth principle was clarity over excitement. He stopped trading earnings for thrill. He stopped trying to catch the big one. He stopped treating earnings like a lottery ticket. He no longer confused excitement with opportunity. Excitement was now a warning sign, a psychological red flag. If a trade felt thrilling, he stepped back. And the fifth principle was process over identity. He stopped defining his worth by whether he was right. He stopped tying his intelligence to the outcome. He stopped viewing trading as a reflection of himself. Trading became a profession again, not a test of ego. He understood something powerful. Being wrong in trading is not failure. Being emotional is. Once he internalized these 5 principles, everything changed. He stopped getting crushed by IV. He stopped forcing trades. He stopped reacting emotionally. He stopped chasing validation. And slowly his performance stabilized. His confidence became quiet, calm, grounded. Not the loud confidence of arrogance, the silent confidence of clarity. This transformation is available to anyone who is willing to confront their own psychology. Because the truth is, IV crush is not a pricing problem. It is a mindset problem. No one loses to implied volatility. They lose to the emotions that lead them into overpriced trades. They lose to the fantasy of certainty. They lose to the illusion of control. They lose to the desperate hope for a dramatic outcome. If you want to survive earnings, or better yet thrive, you must commit to psychological mastery. So let's summarize the deep truths we've uncovered in this journey. Earnings is not a prediction event. It is a psychological event. High IV is not opportunity. It is emotional pricing. Expected move is not math. It is the blueprint of crowd psychology. Losses during earnings are not personal betrayals. They are the cost of emotional attachment. IV crush is not unfair. It is the logical release of collective tension. Your edge in earnings is not direction. It is neutrality, structure, discipline, and perspective. The traders who thrive in earnings season are not the ones who guess correctly. They are the ones who understand the psychology of uncertainty. They understand the emotions that drive the crowd. They understand the illusions that trap the inexperienced. They understand the mental habits required to stay calm when others are panicking or gambling. To handle IV crush with mastery, you must become the kind of trader who accepts uncertainty, detaches from outcomes, sizes responsibly, trades objectively, reflects deeply, controls emotions, respects probability, and avoids the seduction of thrill-driven trades. Because thrill is expensive, excitement is expensive, certainty is expensive, but clarity is priceless. Clarity turns chaos into structure. Clarity turns randomness into probability. Clarity turns earnings into opportunity, not emotional opportunity, but strategic opportunity. And every trader has a choice. You can chase excitement like the crowd, or you can seek clarity like a professional. You can predict, or you can understand. You can gamble, or you can master psychology. Your future as a trader depends on which path you choose. And if you choose the path of mastery, then earnings will no longer intimidate you. IV crush will no longer confuse you. Losses will no longer shatter you. And uncertainty will no longer control you. You will see earnings not as danger, but as data. Not as chaos, but as insight. Not as gamble, but as structured risk. You will finally understand what only a few traders ever learn. The market does not reward intensity. It rewards neutrality. It rewards discipline. It rewards emotional maturity. In the end, the true battle of earnings is not fought on the chart. It's fought in the mind. And once you win that battle, once you cultivate the calm, the clarity, the patience, the neutrality, you don't just survive earnings season, you master it. You master yourself, and that is the ultimate edge. If this message resonates with you, if it brings clarity, if it gives you a new way to approach earnings and handle IV crush, then let this be the moment everything changes. Not the moment you predict better, not the moment you trade more, but the moment you think deeper. Because in trading, thinking deeper is thinking clearer, and thinking clearer is how you win. If there's one truth that echoes through every chapter of trading psychology, it's this: the market doesn't break traders. Their expectations do. Earnings will always be unpredictable. IV will always expand and collapse. Crowd psychology will always swing between fear and greed, but you get to choose how you respond. You get to choose neutrality over excitement, clarity over hope, discipline over impulse, and self-awareness over ego. Every earnings trade is a test not of your ability to predict, but of your ability to stay grounded in a world built on uncertainty. If today's message resonated with you, carry it forward, reflect on it, use it to sharpen your mindset, and strengthen your discipline, because your greatest edge is not hidden in a strategy. It's hidden in your psychology. Thank you for spending this time with me. And if you're committed to mastering your mind so you can finally master the market, make sure you stay connected. This is just the beginning. Until next time, trade calm, trade clear, and always trade from the mind over the markets.